Welcome to our Talk Tickers analyst briefing. Today, we're digging into a real head-scratcher from Build-A-Bear Workshop's latest earnings report. See, management was painting this picture of record-breaking revenues, but investors, they hit the sell button hard. So what exactly went wrong? Let's get into it.
Yeah, that's the number that says it all. A 15.5% drop in one day. This wasn't some minor dip, folks. This was a brutal double-digit haircut that just vaporized a huge chunk of shareholder value in a few hours.
And that really is the million-dollar question, isn't it? On one side, you have the CEO on the earnings call talking about positive momentum and record performance, and on the other, you have a stock price that's absolutely plummeting. So what was hiding under the surface of this report? Let's unpack the numbers and the narrative to figure it out.
First things first, let's just appreciate how fast and how decisively the market made its decision here. This wasn't a slow trickle, this was a high-conviction sell-off, plain and simple.
Now, this timeline tells a fascinating story. The damage started early, right? The stock was already down over 6% in pre-market trading as the earnings call was going on. But then, the moment that opening bell rang, the selling just went into overdrive. It pushed the stock all the way down to nearly $45 before it closed with that massive 15.5% loss. This tells you the initial reaction was bad, and the more people looked, the worse it got.
And look, this wasn't just a few nervous retail investors getting spooked. The trading volume absolutely exploded. We're talking nearly 4 times the daily average. When you see that kind of volume on a day this red, it's a huge signal that the big money, the institutional players, are heading for the exits. They saw something they really, really did not like. So let's get to the heart of it. What did the actual report cards say that sparked this whole firestorm? Let's look at the numbers. At first glance, you might think, okay, this looks like a mixed bag. And you'd be right. The earnings per share, or EPS, came in at 62 cents. That actually beat what analysts were expecting, which was 59 cents. So that's a check in the win column. But the revenue, the top line number, came in just a little light, 122.7 million versus the 124 million expected. A slight miss, but a miss is a miss.
But here's the kicker, and this is so important. While that EPS number beat this quarter's estimate, it was actually down a pretty steep 15% from the same quarter last year. And this right here is the first major crack in that record performance story. You know, it's one thing to beat a lowered bar, but it's a completely different story when your actual profitability is shrinking year over year. And when we dig into where that revenue came from, you can see exactly where the weakness was hiding. Sure, in-store sales and franchising, they grew a little bit, but look at e-commerce, down almost 11%. In today's world, a double-digit drop in your online business is a massive red flag. It's supposed to be your growth engine. Okay, so we've seen the cracks, but you would not know it from listening to management. They were adamant that the business was firing on all cylinders. So let's hear their side of the story, the one they wanted investors to focus on.
This was the opening line from the CEO, Sharon Price John. The message couldn't be clearer. We are having a record year. She's setting the tone right from the top, pointing to the 9-month performance and trying to frame this one quarter as just a small part of a much bigger success story.
And to be fair, their case had some real substance. They pointed to record revenues for the quarter and the year, they stood by their full-year forecast, and they highlighted their aggressive global expansion. Not to mention, new products like mini beans were on fire, and they were giving cash back to shareholders. I mean, from this angle, things look pretty good, right? The company looks healthy.
And this was the big, shiny number they wanted everyone to focus on. For the first time in company history, they are on track to blow past $500 million in annual revenue. That's a huge milestone.
But, as we know, the market just wasn't buying it. So now let's flip the script. Let's break down what investors heard and why it completely drowned out all of that positive news.
This slide right here, this is the whole story in a nutshell. Management kept saying, don't worry, our full-year forecast is safe. But what the market heard, what the CFO said loud and clear, was that new tariff costs were not a one-time problem. Nope, they were a structural, ongoing headwind that was going to keep squeezing profits well into the future. And that headwind had a price tag. In this quarter alone, tariffs took a $4 million bite directly out of pre-tax income. We're not talking about a rounding error here. That's a material hit to the bottom line. And what does that do? It crushes your margins. The pre-tax profit margin got squeezed by 230 basis points. For those not in the weeds, that's 2.3 percentage points. To an investor, margin is king. It's the engine of profit, and seeing it erode that quickly is a giant warning sign that your earnings power is getting weaker. And honestly, it wasn't just the tariffs. It was a perfect storm of bad news hiding just below the surface. You had that ugly e-commerce decline we talked about. You had inventory ballooning by almost 18%, which screams future discounts. You had rising costs for labor and everything else. And to top it all off, about 18% of the stock was being shorted, which means a lot of big players were already betting against it. That's the recipe for a collapse.
So let's put it all together. Where do we go from here? You've got this strong brand and a bull case on one side, clashing with this story of eroding profits on the other. So let's break down our verdict and what we're watching next. Our official rating on Build-A-Bear is market perform. What does that mean? Basically, we think the big move is over. The stock is now pretty much fairly valued, and we expect it to perform in line with the rest of the market. No huge upside or downside from here. So here's our thinking. The bull case is totally real. The brand is powerful, it has pricing power, and their expansion strategy is smart. But that bear case, it's undeniable. These cost pressures are here to stay, which means the era of easy earnings beats is probably over. So our verdict is that this 15% drop, as painful as it was actually a necessary reset. It just repriced the stock for this new reality of lower profits. So how would you trade this? For us, the idea is to go long volatility. Think about it. You have a ton of short sellers convinced the stock is going down, clashing with a management team that's still very confident. That tension makes the stock a coiled spring, ready for another big move, but we don't know which way. So using options, you could set up a trade that makes money on a big price swing, whether it's up or down, as this whole tariff situation unfolds. And finally, of course, we have to say it, this is not financial advice. This briefing is purely for informational and educational purposes. Always, always do your own homework before making any investment decisions.